In the next few minutes, I'm going to reveal what banks don't tell you about your real borrowing capacity. I'll even show you the exact strategies property investors use to extract equity, increase their lending capacity, and keep buying when everyone else gets stuck. If you own investment property, you've probably hit this point. You've got equity sitting there, the property's grown in value, but when you go to the bank to buy your next property, they say no. Or they give you a number that's way lower than you expected, and you're left wondering, I've done everything right. Why am I stuck? I'm Nick from Trellis Finance. I've spent over a decade helping property investors structure their lending so they can scale up without hitting the walls the banks put up. And what I'm about to show you are 3 things that banks assess that most investors have no idea about, and the step-by-step process to unlock capacity you didn't even know you had. Let's get into it. First, here's something most investors don't realize. When you buy a property, the bank will almost always value it at the contract price, even if your property is actually worth more. Let me show you what I mean. Say you buy a property for $800,000. You've done your research, you've done your due diligence, you know comparable sales in the area are sitting at $850 to $900. You're thinking, great, I'm under the market value. The bank's valuation will reflect that. But here's what actually happens. You submit your contract to the bank and they order a valuation. 95% of the time, the valuer will come back with the figure at or very close to your $800,000 contract price, even though the market data supports a higher number. Why? Because banks are managing risk. If you overpay for a property and default, they want to make sure that they can recover their loan. So they anchor the valuation to what you actually paid, not what the property might be worth in the best case scenario. This is a bank policy most brokers won't explain to you because they don't deal with it at the portfolio level. Now, this doesn't sound like a big deal when you're buying your first property, but when you're trying to scale up and buy your second, your third, your fourth, this becomes a massive bottleneck because the equity you think you have, the bank doesn't see it the same way. And that's just the first layer. The second thing banks don't tell you about is having equity doesn't mean you can borrow. Most investors assume, I've got $200,000 in equity. That's enough for a deposit. I should be able to buy my next property. But the bank isn't just looking at your equity. They're running a serviceability calculation, and this is where investors get stuck. Here's how it works. Let's say you own 2 investment properties and your owner-occupied home. You want to buy a 4th property for $650,000. You've got the equity. The deposit isn't the problem. Problem is your rental income. Most banks will only assess 70 to 80% of your rental income as usable income for your serviceability. So if your properties are bringing in $3,000 a month, the bank might actually only count $2,400 of that. On top of that, they're assessing your loan repayments at a buffer rate, usually about 3% higher than your actual interest rate. So even though you're paying 6% on your loans, they're calculating your serviceability as if you're paying 9%. Now, add in your living expenses, your owner-occupied loan, and any other personal debt like car loans or credit cards. Then what happens? Even though you have $200,000 in equity sitting there, the bank says your income can't service the new loan. You're capped. Not because you can't afford it in reality, but because of how the bank's calculator is set up. Most investors don't realize this. They think their serviceability is fixed when it's not. It's actually influenced by which lender you use. Some assess rental income at 80%, others might be as low as 70%. How your debt is structured. Is it deductible? Is it non-deductible? Whether you've got personal debt eating into your capacity, or whether there are loans cross-securitized, making it harder to restructure. And this is where I see investors lose years of compounding growth because they're stuck in the wrong structure and don't know how to reset it. Now that you understand how the banks assess you differently from how you assess yourself, let me show you 3 levers that you can actually pull to unlock capacity. The third one is the most powerful, but you need to get the first 2 right or it won't work. Number 1, shopping around for lenders. The first lever is lender selection. And this is not about interest rates. Different banks assess your income differently. Some banks will shade 80% of your rental income, others will shade down to 70%. Some will apply higher interest rate buffers, and others are more lenient. Here's a real example. I had a client who was declined by their current lender for a $650,000 loan. We switched them to a different lender, same income, same deposit, and they were approved for $680,000. Same client, different lender, $30,000 more in borrowing capacity. Why? Because the serviceability calculator at the second bank treated their rental income and living expenses differently. This is insider knowledge. It's not published and you can't Google it. You need to know which lenders have the policies that suit your situation. And this is where most DIY investors or inexperienced brokers lose the game because they don't know the nuances between lenders. Number 2, debt recycling to free up capacity. The second lever is debt recycling, and this is one of the most underused strategies I see. Here's the concept. Let's say you've paid down your home loan and you've got $500,000 sitting in offset. That's great, but it's not doing anything for your serviceability. or your tax position. What you can do is this: pay $500,000 into your home loan, immediately reborrow it as an investment loan. Use that $500,000 to purchase 2 properties. Now, instead of one owner-occupied property, you have 3 properties. And the debt you've created is tax deductible because it's tied to income producing assets. This does 2 things. It unlocks equity without selling, and it converts non-deductible debt into deductible debt, improving your cash flow and tax position. But here's the critical part. You must structure this correctly with your accountant and your broker before you act. Because if you redraw the funds for the wrong purpose, you lose the tax deduction. And if your lender won't allow you to borrow it back, you've just locked yourself out of your own equity. This is not a DIY strategy. But when it's done right, it's the fastest way to scale. Number 3, the big one, the reevaluation reset. The third lever, and this is the one most investors have never heard about. Remember how I said banks value your property at the contract price? That creates a problem at purchase, but it also creates an opportunity immediately after. Here's how it works. You can buy your property for $800,000. Your bank values it at $800,000, so you settle. Now, internal bank policy usually prevents the same lender from reevaluating that property for 6 to 12 months. But here's the workaround. You switch lenders. You go to a different bank and request a desktop valuation. That second bank isn't anchored to the purchase price because they didn't fund the original loan. They're assessing the property fresh and utilizing recent comparable sales. If that second bank values your property at $900,000 and you refinance at 80% LVR, you can now borrow up to $720,000. That clears your original $640,000 and puts $80,000 in usable equity back in your pocket. This is how sophisticated investors scale quickly. They don't wait for equity to grow. They engineer it through structure and lender strategy. Now, if you've been investing for a while and you already own 1, 2, or 3 properties, there's a good chance your portfolio is silently capping your capacity right now. And the scariest part? Most brokers won't pick this up because they're focused on getting you the next loan, not diagnosing your entire structure. This is one of the most common traps I see, and it's called cross-securitization. This is where the bank has linked multiple properties together as security for one loan. It sounds convenient at the time, but it creates a massive problem later on. Because now, if you want to refinance one property to pull equity out, you can't. The bank won't let you touch it without refinancing the entire portfolio. And if one property underperforms or you hit a serviceability limit, you're stuck across the board. In the end, one of the biggest mistakes you can make isn't the properties you buy, it's the way your debt is structured around them. I've seen investors with $1 million in equity who can't access a single dollar of it because their loans are tangled together. Their non-deductible debt is eating their serviceability, and they're with a lender that won't let them restructure. The fix? You need a portfolio reset. That means separating your securities so that each property stands alone, converting non-deductible debt to deductible debt where possible, and moving to a lender that allows you to keep scaling. This is the difference between someone who owns 2 properties and stops, and someone who builds a portfolio of 5, 7, or 10 properties over the next decade. So now you've got the insights to unlock more borrowing capacity. Even when you're thinking you're stuck, remember, banks will value your property at contract price, not market value, which caps your equity at purchase. Serviceability is more important than equity, and it's not fixed. It's influenced by structure and lender choice. The 3 levers you can pull are lender shopping for capacity, debt recycling to unlock equity, and the reevaluation reset to extract value immediately. If you own property and you're stuck, it's almost never the property, it's the structure. Now, if you're serious about scaling your portfolio and you want to know exactly how much you can borrow, how to structure your loans, and which lenders will give you the best capacity, book a strategy session with me to go through your specific situation. The link is in the description. Thanks for watching. I'll see you in the next one.